Welcome to the What to Watch video update. This is the last video that I do over the weekend. I do a video every day. I do a weekly video. I do an intermarket analysis video. Then I do a thing called the deep dive video. And then the very last video that I do is this one, where I take the charts that seem to be telling us something right now and I put them into three categories: positive, negative, and then those things that we're just keeping an eye on. Just as we're working our way in through the middle part of September, we're coming into potentially a weak seasonal time, but the market has been looking pretty good. There's a lot more positive than negative right now, but there's always some things to be concerned about. And the Fed is going to be meeting this week, and it's very likely, almost 100%, that they are going to cut rates a quarter of a percent or 25 basis points. And another rate cut is anticipated when they meet at the end of October. And the market's kind of riding on that. And as I've been trying to mention, just like sometimes we see with earnings reports, the stock will go up and up and up and up. And then the earnings report comes out and it's very good. And they even have good forward guidance. And then the price just tanks after that. We have to always be aware of that. The market's been kind of building up in anticipation of the Fed cutting rates. Is it going to be able to hold on to these gains if and when, because they're going to cut rates after they actually make the announcement? There'll be the gyration that happens, that always happens when rates are actually changed. But what are they going to say? What's the press conference going to be like? And those are some variables we don't really know right now. And so will the market take that as positive or negative? After the rates have been cut, are some folks going to want to come in and take some profits? So, okay. The question we're asking this week is, can the S&P 500 keep making new highs? Now, we didn't set a new high on Friday. We did on an intraday basis, but we didn't on a closing basis. But the NASDAQ and NASDAQ 100 did. And we're close. We set an all-time high on Thursday with the S&P. So things are looking really, really positive in that regard. We're seeing a pickup in the short-term conviction that we hadn't really been seeing before. And we're seeing some things that, of course, we need to be concerned about, just because there's always something to be concerned about. All right, let's go through the positive slides first. And that's where most of the charts are at right now. We had an up week. We go back to Monday. See, not an awful lot of conviction here, but not a lot of weakness either. And then in Tuesday's session, we saw a little bit of strength going into the close. And we actually gapped higher. This is more of a negative day than a positive day, even though we were up. We gapped higher, but then came down. So if you just look at the pattern, these are 10-minute candles right here. It's not very good looking, but we did end up having a positive close. Then most of the strength really came on Thursday. We gapped up and then we were able to go up right after the open and then maintain those gains. And then Friday was a real yawner. We just kind of chopped above and below the unchanged level. We did go up and hit 6,600, and that's acting as overhead resistance now. It's also a round number. That was where we set the high, and then we drifted down from that. Okay, daily chart. Looking pretty good. We're above this pivot point here. It may act as support, but we're still pretty close to it. So it may not provide all that much support there. But we're in an uptrend, and most of the days, except for Friday, we were actually above average with volume. Now, another thing, I try to use my own charts in this, but there's a few that I pull from other sources. Investors Intelligence. These are folks that come out and make recommendations, buy, sell, and they have this way of calculating that, whether it's a newsletter or a website or what have you, and they put it all together and say, what are most of the recommendations out there? The reason why I'm showing you this chart is the top part of it here. We get above the 3 level. That's when we're getting a little too exuberant, a little too bullish out there. Now, there's nothing to say that this red line can't continue to go up. We just start to watch this when we do go above the red line itself. And then there's other surveys here, but I mainly focus on the very top chart. Then we're also looking good with the VIX. We're under 20. We're below the moving averages, both with the line chart and the bar chart. It means there's less fear in the market. We're doing okay here. We see the blue line slightly above the red line. That means growth on an intraday basis with a 15-minute bar chart or line chart, actually. That means growth is outperforming. And that's what we want to see. We want to see the blue line above the red line. But the big thing is, are these lines going up? And for the most part, yes, they are. So even if the red line is above, if they're both headed higher, that's taken as positive. And then we look at an intraday growth to value chart for the S&P, and we're seeing a nice little move up since the beginning of September. Now we're coming up and then falling back, coming up and then falling back. But then I have the moving averages on here, and we're still above all of the moving averages overall. So not showing tremendous strength, but trending higher nonetheless. And we look at our growth to value ratios for the most part, positive right now. The Qs to S&P coming back above the moving average. Discretionary to the S&P, this has been one of the stronger areas. That's looking better. That's above the moving average. And large cap growth is outperforming large cap value. So we're looking okay with the large caps. That's where the strength is coming from. Seeing a little bit of an improvement above the moving average with the mid caps, but we're not seeing much of an improvement here with the small caps. So we look at this growth to value ratio. Again, it could be stronger than it is right now, but we're still above the rainbow. And large cap growth set a new all-time high on Thursday, set another new all-time high on Friday. This is the strongest part of the market currently. And we're going up now. We were chopping all around with our risk on to risk off ratio. We're trying to break out. Can that continue to go up? Also, we're breaking out after kind of chopping around sideways with our high beta to low beta ratio. That's positive. And when this ratio is going down, which is what it's doing, that's value to tech or growth. That is also positive for the market. Then we look at the S&P to utilities. Not a lot of conviction here, but for the most part, we're seeing the S&P outperforming utilities, and that is taken as positive. Now, when this ratio is going down, staples to tech, that is positive, and that's what's happening here. And when we look at staples to the S&P, the ratio is going down as well, and that is taken as positive. Then we look at discretionary, which has been one of the better performing areas. At least it was back in 2024. At the end of August into September, that's when it took off and really performed well for the end of 2024. We're starting to see it improve. Are we going to see a similar thing happen in 2025? So we're looking at the equal weight discretionary to staples ratio. It's continuing to go up, and that is positive. And even though not showing an awful lot of conviction, we're just coming off of all-time highs with the advanced decline line based on price and volume, and we're above these advancing moving averages. So that is positive. And I'm putting this kind of together here. You could possibly put this on the negative side. This is a 10-day advanced decline oscillator. But this also shows not a lot of conviction right now. Once we got into August, we would go a little bit above, a little bit below, and we're just kind of choppy at the current time. And we are positive, even though our 5-day moving average is going down, it's trying to turn up, and we're flattening out with the 10-day moving average. But what I'm looking at here is mostly a lot more green than we're seeing red. That means there's more new highs than new lows, and that's an internal measure, and that's still looking pretty good. And then our one smart money indicator is still positive. Even though we declined a little bit with accumulation distribution, we're still above the moving average. This is shorter term called the boom indicator. This is a modified MACD momentum oscillator where it's coming down, but it's still above its moving average. But we're above this red line. That's usually when we start to get a little nervous because it's giving us an extreme reading. But still, it hasn't actually flipped over to negative. Now, our other smart money indicators are going to be on the negative side because they did show some weakness on Friday. Now, we look at our trend. First of all, we look at the short-term trend. A week ago, we were not trending. We actually had dropped below 20. Now we're coming back. The ADX itself is the black line that you see here. And we're going up above 20. So that means we are trending and we're above the moving average. And when we're above the moving average, that is a strengthening trend. And then we're positive because the green line is above the red line. So this is a positive strengthening trend in the short term. Same thing here in the intermediate term. Above the moving average, green line above the red line, above 20. Strengthening intermediate term trend that is positive. Long term, we're still not trending. We're below 20 with the ADX. We're below the moving average, but we are still positive because the green line is above the red line. Then we look at our momentum oscillators, which have been just drifting down as the S&P has been going up. That's a negative divergence, but we're starting to see some improvement. We're turning up with our two short-term oscillators. We're starting to show some improvement with the intermediate term, and there are 3 of those oscillators here. We're a little bit improving here, but we're still pretty much negative with our two long-term oscillators. And we're turning back to positive with the Copic curve, which is another momentum oscillator. And we're trying to turn up here with the PMO. We already saw the PMO on the previous chart with all the oscillators on there. Then we break it out here based on price. Not a lot of conviction, still below the moving average. We're still below the moving average based on volume, but it is trying to turn up. So we're seeing a little bit more strength there. Then there are all these studies. What are the PMOs inside of the S&P 500 doing? This is actually a little bit more negative, where we're dropping below 50 with the PMOs that are rising, but we are seeing a bit of an increase, but leveling out right now with the buy signals, but it's still below 50. And when you look at the percent of PMOs inside the S&P, it's still at 67% here, and that's a fairly high reading, and we pretty much have been able to maintain that lately. Now we look at the daily parabolic SAR, positive with the dots underneath. Weekly parabolic SAR, positive dots are underneath there. Confirmation in the shorter and longer term time frames. Then I don't show this very often because I only use this chart in the videos when we get above the black line or below the black line down below. This is a CMB composite, another momentum oscillator, and it's looking positive, but it is extreme. And we're looking good here. The short-term trend, the green fluorescent line here, that's a 10-period simple moving average. That's above the 20-period and 30-period exponential moving averages. Prices above all the lines, and the lines are going up. That's more short-term, and that is positive. And we look at the condition of the short-term trend based on 20 periods, going up with the blue line and the green line, and prices above both. We look at the condition of the intermediate term trend. We're above the red line and the blue line, and both are going up. So that's positive. Then we want to keep an eye on the 20-period simple and exponential moving averages. Now, this is on another chart, but this is a breakaway chart just for these moving averages here. If we start to fall, so far we've been using the 20-period moving averages as support. And that's positive that any kind of pullback or correction can take place at the short-term moving average. So we'll be watching that. It's positive because price is well above it. Unfortunately, we're kind of far away from it right now. And when we get too far away from a moving average, then it has a tendency to come back. But here are all the different moving averages. The 20s on top, then the 50, then I have a 100 and 200 moving average study here. This is what I'm talking about. The boom indicator, it measures how far is price above or below the 20, 50, and 200-day moving averages. Well, we're kind of far away. We use this like an oscillator. We're far away with the 20. We're far away with the 50. We're still looking okay with this moving average study. There's a different 200 moving average study I'm going to show here in a moment. In fact, it's right here. One thing just to be aware of. Now, this is just something to watch. It's not flashing anything negative. But when we get about 10% above the 200-day simple moving average, now we can go higher than that. That's why we don't really know what this is going to be. But if you look at this, when we get above the dashed line, that's at about 10%. Then we get far away from the 200-day moving average. Then we see a correction after that. That happened back in 2023. It happened a couple of times back in 2024. It has not happened yet in 2025. But now we're starting to break above the 10% level with the 200-day simple moving average. Now it could go higher than this, but this is where we just keep an eye on this a lot closer. And then we look at other charts to say, okay, are we becoming overbought and extreme? Are we hitting overhead resistance? And then this kind of feeds into that. Now, over the summer, I did a video where we've been watching for some kind of correction because in 2023 and 2024, about midway through July, we had a correction. It didn't happen this year. One of the reasons I said in that video is in July here, we were not even at the 10% level. So I said that's one of the reasons that we may not get a correction. Well, now we're starting to get into that territory again. Just something to be aware of there. We are positive with the bullish percent index. We're above the moving average and going up. We're also positive with the NYSE bullish percent index. And even though we ticked down a bit on Friday, we're still above 50 with the NASDAQ 100 bullish percent index. We're positive with the vortex. I use this as a primary indicator. The green line going up. The red line's actually coming up. One thing to be aware of on the negative side is we were getting a really low reading here with the red line. That's why I have this line down here. It could be becoming a little bit oversold in that regard, that maybe all the selling has gone away. And actually, I need to reverse that. Maybe there's been too much selling, and now there's going to be some. Okay, Anyway, be aware of this. I don't want to go back and re-record this, but this is coming off of an extreme reading. Just take that. Okay, and then for 2 days, Thursday and Friday, we closed above the upper Bollinger Band, and that doesn't happen very often. And when it does happen, it tends to not last very long. And so, what's going to have to happen? Are we going to come down with price, or is the upper Bollinger Band going to have to go up, or a combination of the two to work off this extreme reading? We did see enough of an upward move on Friday to get to the 6,600 level, the point and figure chart. This just looks at price. It doesn't consider time in the equation. Doesn't matter how long it takes. It's just how far does price move. When it moves far enough, it draws in an X. If it goes down far enough, it draws in an O. And we're still working off of a ascending triple top breakout that was generated back on August 13th. We're positive here with the daily special K chart. This is a very long-term oscillator. I don't show this in the daily videos because we didn't even get a single signal in 2024. We've had two now in 2025 where we crossed below and went negative. Now we've crossed back above positive. And I mentioned this, but now I figured I would show it. We're also positive with the longer term weekly special K charts. So that's longer term positive there. Also, we're coming up to the upper end of this trend line. We're actually starting to break above it a little bit with the S&P 500. Now, we got above this back in 2021, and that's when we were getting real euphoric as far as the market was concerned. And then we went into the bear market in 2022. So it's positive, but just be aware that we're starting to break above the upper trend line here. And we're looking okay, but not super, super strong. When we look at the cumulative advanced decline line for the S&P based on price and volume, we're actually looking a little bit better on volume. We're just kind of chopping around based on price. That could be taken as positive when we see volume leading price. And I have a number of different moving average studies. Even though we declined on Friday, we're still above 50. These are the stocks inside the S&P that are above their 20-period moving averages. That's shorter term. It's positive since we're above 50. Now, in the bigger picture, I've been trying to point out these negative divergences. We've been setting lower highs here as the S&P has been going up. Now, that could all be negated if we come back and take out some of these previous highs here. But in the meantime, it's still here for right now, so we just want to be aware of this. Also, a little bit of a negative divergence with those stocks above their 50-period moving average, but we're still positive since we're above 50. We're not really seeing any negative divergence in the longer term with the 100-period moving average study and the 200. And I've also been pointing out here, in fact, with the 200, we've actually been setting a series of higher highs, a high here, a high here, a higher high here, a higher high here. It would be even more positive if we set a higher high here. But be aware, we're also worried about getting more than 10% away from the 200-day moving average. So some positive price action might bring in a lot of buyers from the sidelines, but we might get into an overbought situation and where folks want to start taking profits and we see a decline. Then this has been positive now for 2 weeks. This is a weekly chart of the S&P. We closed above this R1 pivot point. We were below it for like 3 weeks. And now for the second week, we closed above it a week ago and we actually broke above it now. So, and if you look at the bars these are weekly bars here, they're looking good with higher highs and higher lows. And then I break it out and look more at the broad market, where this is the common stock advanced decline line, just not really doing great right now, but not really showing any weakness. We're seeing a little bit more conviction here when we break this out based on volume, and that is positive when volume tends to lead price. Now, part of this is positive, part of it's negative. We're still above the moving average when we look at the NYSE common stock and the S&P, but the mid caps and small caps, which had a great week a week ago, didn't have a good week this past week. So we're seeing a little bit of weakness and dropping down below the moving average with the mid caps and the small caps. Then we look at a broad market measure of the Amex, NASDAQ, and NYSE and look at a 5-period moving average of the highs and lows. This is longer term positive and it's more internal. This continues to go up and we're above zero. So that is taken as positive there. And then we look at the NYSE McClellan oscillator. Even though it declined on Friday and we're setting a series of lower highs here as well, we're still above zero. So when this is above zero, we're going up with the summation index based on price, going up with a little bit more conviction than we are based on volume. That could be a little bit of a concern there, but both are advancing. So the broad market's looking a little more positive. When we look at the S&P McClellan oscillator and summation index, they're negative. They're over on the negative side that I'm coming up to. Now, there's some positive and negatives here. The equal weight S&P did set a recent all-time high. That's positive. But when you look at the QQQ equal weight, it has not set an all-time high, but it's mainly the big stocks that have been driving things higher. But so you would think this would be doing better than it is right now. That's the negative side. The positive side is that we're setting new highs here with the equal weight S&P. The Dow is in an uptrend, setting an all-time high, and it was down on Friday. It set the all-time high on Thursday, and we did set another new all-time high with the NASDAQ, and it was up, and it actually came above this R1 pivot point. That's positive. And the NASDAQ 100 broke above its R1 pivot point as well. So they're above resistance for right now, and it did set an all-time high on Friday. And after a long time, we're finally starting to turn back positive with the momentum for the NASDAQ 100. A longer term chart here going back to 2009. This is a weekly chart of the NASDAQ 100. We're above this trend line, and that's positive in and of itself. And we look at the small caps, which are positive, but now they're back to their sideways action currently. And the other small cap index, the Russell 2000, this looks a little more healthy when you look at the overall bar pattern of higher highs and higher lows. And it is positive, but we're kind of starting to see some favor coming out. We're wondering if that favor is going to come back. But we're still above 50, even though we're declining with the RSI, and we're seeing a little bit of a meltdown here with the short-term momentum measured by the MACD. And then even though small caps have seen some favor lately, they've got a long ways to go to start outperforming the S&P 500. So yeah, it's positive and they're in uptrends, but I wanted to include this with the other small cap charts, and they've got a long ways to go there. Mid caps also in an uptrend overall. The Wilshire was down on Friday but set an all-time high on Thursday, and the same thing is true with the total US stock ETF. Financial sector looking good all by itself, but for it seems like forever now, going back to early summer, back into May, we've seen the financial sector really underperforming the S&P. It was starting to improve. It got back above its 50-day moving average, but now we're seeing some weakness again. We want the financial sector to do better and actually outperform the S&P in a more positive environment. FANG index, these are the big stocks. Up a little bit in Friday's session, just barely an all-time high there. And then we look at some ratios. The Qs to small caps, this really came down last week, but small caps didn't have a good week, so we ticked back up with this ratio. But overall, when we're above the blue line and going up, we are positive. Then we look at some ratios between stocks and bonds. Doing really good here. When this is giving a high reading, that means the market is anticipating a soft landing, which means no recession. This is that same study, but inverted. This is showing how bonds are underperforming stocks. We look at the S&P 1500, the short-term bonds, new high there, even though it was down a little bit on Friday. Another broad market measure, the 3 to 7 year bonds, this was up, set a new high in Friday's session. The Qs to 3 to 7 year bonds, not quite back to this previous high, but still looking positive. The tech sector to 3 to 7 year bonds, again, not surpassing this previous high, but still up out of the rainbow. And then home construction has been improving. It was really not doing well for most of 2025. It actually started to break down in late 2024. Now we're coming back up out of the rainbow, and we're staying above this, and so the lines are starting to turn back up. NASDAQ to Dow ratio still above this red line. That's positive. Semiconductors to Dow, that's growth to value. We're just kind of chopping around here, but we did go up a little bit, and we're getting closer to that blue line. And the semiconductors themselves, now they were up a little bit here in Friday's session, but we are breaking out to a new all-time high. Also setting another new all-time high here with the SMH semiconductor ETF. Now this is okay, but we'd like this to do better. This is the semi to tech ratio. When this is really going up, that means the semiconductors are outperforming the tech sector. We want them both to do well, but like in early 2024, this is when the market really screams up, when the semis are actually outperforming the tech sector, which is also, the tech sector is also doing great by itself. But don't be afraid if this starts going down. In late 2024, this ratio was going down, but we were still going up with the S&P. Now we go over to the negative side. And this is what I'm finding kind of interesting here. This could actually be positive for the market, but the overall trend of this chart has been down. This is sentiment, fear and greed index. And we tend to go with it, whatever direction it's going for the most part, until it gets either to 75 or thereabouts or down to 25 or thereabouts. But this could actually be positive for the market because you've got a lot of people that aren't trusting this rally. A lot of people think, oh, it's September, stocks are automatically going to go down. Well, that's a lot of people thought that for August, and it didn't happen. And we were coming into the second half of September, which is usually the worst performing time of the entire year, going back to 1950. And so you got a lot of people that are suspicious of this, and that could actually work to the market's favor since we're not seeing really extreme sentiment. We're not really euphoric according to this measurement right now. But if we do start to go up and people are sitting on the sidelines going, oh my gosh, I'm missing out on these gains, I have to jump in. That's FOMO. That's the fear of missing out. And that could really push this sentiment gauge up. Then this is another thing that could work in the market's favor. Individual investors, they're even more bearish now than they were a week ago. And we're setting all-time highs with the S&P. A lot of suspicion going on here. If we start going up, the same thing could happen here. They may want to jump in. And when I say they, I mean us. Anyone watching this video is in this group, even though this is an organization, but we're all individual investors. But there's more room to run to the upside before this becomes extreme. And then this is actually negative. The chicken money flow. And the reason why this is negative is because we're negative here. We're more bearish. And we're going down here with the histogram. This is smart money indicator number 2. And the red line's now going down. And we're also declining and coming down below this red line with chicken oscillator. And this is smart money indicator number 3. So 2 out of our 3 smart money indicators are now negative. And we're below zero here with the S&P McClellan oscillator, where we declined with the NYSE McClellan oscillator, but we're still above zero. You can see not a lot of conviction here. A little bit above, a little bit below, a little bit above. You could make a case here for some negative divergences, lower highs here, going back all the way to May, as the S&P's been going up. But again, that could get taken care of with some good solid upward moves. But in the meantime, we have to recognize this for what it is. It's like there's less enthusiasm as we've been going up. So we are declining a little bit based on price, but we're still going up based on volume. So we're getting a mixed signal here with the summation index. Also a mixed signal here. We're declining based on price. We're still advancing based on volume with the Swindle Trading Oscillator. This is actually more negative than positive. This is the NYSE Zahorchak method. We had come all the way down to a -10, and then we bounced up to 0, and now we've come back down to a -6. So that's why this is a more negative in context here. And then we're just not really looking good with our small cap growth to value ratio. Yes, we've been seeing some improvement with the small caps. This is another negative divergence. This ratio has been going down. When it's more positive, you would expect this ratio to be going up. Now, not quite as negative here with mid-cap growth to value, but still not really showing any leadership there. And also S&P growth to value. We started to come down at the beginning of August, and this is the market potentially becoming more defensive. We fell down below the 50-day moving average, and we're still below it. We can't seem to get back above it here. That's why I'm treating this as negative, even though in the bigger picture, we are still positive since this is in an uptrend. And then we were above the green line here with the 10-day average of the highs and lows for the S&P. We're coming down here, and that's longer term. And to see this coming down is a little bit of a concern there. And then the areas that we're just keeping an eye on. We've been really range bound with the initial jobless claims that come out every Thursday. Well, we saw this really jump up. This is what got the market all hot and bothered, because if the employment situation is looking a little bit weaker, that's what the Fed has been using to justify keeping rates higher for longer. So this jump up was actually taken as positive news. But if this really keeps going up, eventually this is going to turn into bad news. Now, we didn't see a change here with the continuing claims. This first chart, these are just folks that are filing unemployment for the first time. These are folks that are they're unemployed longer. And this actually declined a little bit, but overall we've been in a higher range, but we have been range bound for the last few months. And taking all of this together, we saw a real big upward move in the initial claims, flattening out with the continuing claims. And then a week ago, we had the updated unemployment rate coming out at 4.3%. And this is helping the market too. We're continuing to drop for the most part with the 10-year yield. If that can continue, we got close to that 4% level, and then we started to bounce up from that. Are we going to see more of an upward move now? Because that's a round number that so far we've been bouncing up off of that. But if interest rates can continue to stay low, that will be more positive for stocks. And we're seeing a little bit of an improvement, but overall kind of a deterioration here between riskier bonds like junk bonds and conservative bonds like government bonds. And when this ratio is going down, that means that folks are favoring the more conservative bonds. When the market's really doing well, this ratio has a tendency to go up, and pretty much you're going sideways here. Not seeing an awful lot of weakness, but seeing a lot of strength either. Now we look at the interplay between inflation and interest rates and what's the market saying. This going down means that in the short term, the market's not concerned about inflation. If they were concerned, this ratio would be going up. Now we are going up with this one, and this is more intermediate term, so we'll keep an eye on this. But when we look a little further out, we're still going down here. So we're getting kind of a mixed picture. I would take that for right now, meaning that the market is not really worried about inflation at this time. And then the large caps, they typically outperform the small caps. Then we've been going sideways for a number of months. This ratio was coming down when the small caps were seeing a little bit of favor. Now we're going back to sideways again here. And then oil, we are in a downtrend here and we're getting into the lower 60s. I watch this mainly for geopolitical reasons. And the dollar is in a downtrend. And I don't have the chart here, but the weekly chart is also in a downtrend for the dollar. And that's been positive for stocks. And we're not really seeing any fear here. This is the spread between risky and not as risky bonds. When this is going up, that means fear is going down. And retail, and this is kind of a funky chart here. The retail's right in the middle. Then you have the study on top, which is kind of backwards from how I show most of the charts. But if you look at retail itself, it's in an uptrend. And so that's positive. And we're still above 50 with the RSI. Now, on top is a ratio between retail and the S&P, and it's been underperforming now for quite some time, the last few years. We're starting to level out here and actually showing a little bit of an improvement. Now, we're going to continue to watch this to see if there's any more follow through to the upside with this ratio. And then this is just another area we're keeping an eye on. The top part is the weighted discretionary to staples. When this is going up, that's more positive. Then we have the equal weight discretionary to staples, and that for the most part is going up. So these are confirming each other. Then we get some mixed signals here. The tech to utilities ratio, that's a growth to value ratio. Seeing a little bit of weakness here after it had been going up. Also a bit of a drop off with biotech growth to healthcare value. That's coming down a little bit. And we're seeing a little bit of weakness here with hotels to utilities. So we would like to see all of these ratios going up. We're seeing discretionary and staples going up, but we would like these other ones to go up as well. We want to keep an eye on what are considered to be the bellwether industries here. Semiconductors looking pretty good. Then we look at the home builders. They've been improving quite a bit. And transports going sideways like they've been doing for quite some time now. Retail is in an uptrend, even though it pulled back on Friday. And then regional banks, they're just going sideways right now. We want to keep an eye on the German DAX because that's the biggest stock market in the EU. Not doing as good as the S&P. We're back below the 50-day moving average here with the German DAX. And when that happens, when we do a ratio between US stocks and German stocks, this ratio is continuing to go up. It was really going down earlier in 2025, and then it bounced all over the place. And now it's been starting to improve here. The more this goes up, that means the more US stocks are coming back into a leadership role. Then we look at gold to the S&P. Gold's been breaking out. The S&P's been doing well. This ratio is going up a little bit. We'll really only pay attention to this if we come back up to this kind of gold trend line here. And then we really saw a big move up here with the momentum stocks to S&P ratio. Well, now it's pulling back and we're pretty much in a range currently. And then US versus international stocks, we were seeing US stocks starting to outperform. Now we're more or less going sideways. Not just against Germany, where we're seeing some improvement, but when you take international stocks as a whole, we're not really outperforming when you look at US stocks. And breaking out a little bit here, when we look at emerging markets to developed markets, after we've been range bound for pretty much going back to the beginning of summer. Then these are the pivot points for Monday's session. For those of you that come to my website, this chart is there. I also post this same chart on the YouTube community tab. I don't have a way of being able to post this on Rumble. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.